It has been exactly 1 month since Donald Trump took office as President of the United States, and in just 4 weeks, his policies have already sent the first shockwaves through the global economy. The so-called Trump tariffs, which haven't even been fully implemented yet, have already pushed inflation to a concerning 3%, a level not seen since last June. This has effectively wiped out the Federal Reserve's efforts to control inflation. Last week was a nightmare for financial markets. The latest CPI report left a trail of blood across Wall Street, sending US stocks into a tailspin. Meanwhile, the cryptocurrency market was thrown into chaos, Bitcoin hit a fresh weekly low, and altcoins suffered double-digit losses, leaving investors in shock. The real issue lies in Trump's core vision: make America great again. To achieve this, he's willing to use every tool at his disposal. Remember how Trump criticized the Democrats for pushing the national debt to a staggering $36 trillion. Now he's hinting at a possible selective default, suggesting that the US could refuse to pay certain debts it considers unnecessary. According to Elon Musk, whose department is exploring this scenario, such a move could shatter global confidence in US financial stability. The first major consequence of Trump's economic policies is inflation, which significantly reduces the chances of the Federal Reserve lowering interest rates. Trump has already sent his people to lobby Fed Chair Jerome Powell, potentially pushing the central bank into an early rate cut despite rising inflation. This could be a short-term win for stocks and crypto, but how long can this fragile system last before it collapses, just like during Trump's previous term, when inflation skyrocketed to a 40-year high? The latest U.S. inflation data for January has only heightened investor concerns. CPI exceeded expectations at 3%, up from the forecasted 2.9%. Even though the latest Bureau of Labor Statistics report doesn't cover the first weeks of Trump's presidency, the data suggests that controlling inflation will be a much tougher challenge than anticipated. High inflation means high interest rates, making Fed rate cuts in 2025 increasingly unlikely. This puts pressure on both the stock market and crypto, while boosting U.S. Treasury yields. Investors are pulling out of riskier assets and shifting towards safer options like bonds. Trump is directly pushing for lower rates, even after the CPI report, aligning with his upcoming tariff policies. Trump has begun lobbying aggressively through his inner circle. Kevin Hassett, who heads Trump's National Economic Council, now holds regular meetings with Fed Chair Jerome Powell. When asked about influencing rate decisions, Hassett's response was carefully worded. Jerome Powell is an independent figure, and the Fed's independence is respected. However, the president's opinion also matters. After all, he is the leader of the United States. Trump's key players are applying pressure on Powell openly. Hassett pointed out that long-term Treasury yields have declined by 40 basis points since Trump took office. Trump has already ordered new tariffs, starting April 1, targeting the European Union and other countries. Analysts predict this will drive inflation up by an additional 0.5% to 1.5% this year. Bitcoin has been trading between $90,000 and $105,000 since Trump's inauguration, failing to establish strong support above $100,000. Some traders believe a short squeeze is imminent. Key Bitcoin levels include $93,300 as support and $99,200 as resistance. Another expert sees $102,500 and $105,000 as short-term peaks, but warns of a possible drop to $80,000 before recovery. Rising inflation expectations have historically preceded market tops, and we haven't seen this signal yet in 2024, hinting at an early bearish phase. However, some on-chain indicators remain positive. Market expectations for a 25 basis point rate cut sit at just 2.5%. Suggesting continued tight monetary policy. Currency flows show troubling signs, with Bitcoin movements indicating risk aversion. However, blockchain data shows strong investor demand, with Bitcoin's 30-day moving average in a high accumulation zone. The new BL indicator for long-term holders suggests euphoria, though the cycle's peak is likely above $120,000, $150,000. Crypto funds lost $415 last week, with Bitcoin leading at $430 million in outflows. On February 16th, indicators turned negative for the first time since Q3 last year. Analyst Axel Adler noted that liquidated Bitcoin longs reached a 2-year high, though strong buying pressure during corrections has limited Bitcoin's decline. However, things aren't completely dire for holders. Market responses indicate strong demand during the correction, limiting Bitcoin's decline. Material indicators warns about death crosses on the daily chart, signaling bearish trends. But with key support levels at $95,000 and $92,000, the drop may slow. Some analysts, like Kit Allen, remain optimistic, viewing the correction as a market shakeup and planning to strengthen long-term positions. QCP Capital expects more moves once economic news surfaces, signaling investors are holding out for a reversal. They note reduced options market activity awaiting economic signals. I'm monitoring Bitcoin's upward trend line closely. A break would signal a trend change, but if it flips into resistance, it could lead to testing the 200-day EMO. Past similar phases show that once weak hands exit, positive news could spark a surge. The market corrects slowly but grows quickly, so waiting for recovery is key. Well friends, that's all for today. Don't forget to subscribe to our channel to stay updated on new videos, and share your opinion in the comments. Good luck, and until next time.